Welcome everyone to our M&A webinar. We've got folks joining, so we're going to give it a couple of minutes. The plan is to start at right at 12. So we appreciate everyone joining us for this webinar. I think we got a lot of good information, and so a couple of minutes, we'll get it going. Couple of things while we wait to get started. We will have the ability to post questions. So although everyone will be muted, there is a chat feature as part of the GoToWebinar where you can post a question to there. Cami Miner is helping us facilitate this, and she will bring up the questions and we'll answer them as best we can. All right, we've got a lot to cover, so my clock's showing 12, and we're going to go ahead and get started. My name is Brandon Smith. I'm a partner with Anglin Reichman Armstrong. We have offices in Huntsville, Alabama, and Pensacola, Florida, although we have clients throughout the U.S., particularly in the government contracting space. We are a full-service accounting firm providing audit and assurance services, tax advisory services, and consulting services. Being in the markets we're in, we do provide a niche focus on government contracting, and this webinar today will focus on that as well. One of my partners, Ryan Campbell, is on the call as well, and I assure you, when we were planning this, I was told I need to update my headshot. I assure you, you have the right people on the call, and you're in the right place. Just my hair is a little bit longer, and I've grown a beard since my last headshot. But Ryan's the partner in charge of our Pensacola office. Ryan, you want to introduce yourself?
Yeah, sure. Ryan Campbell. I was up in the Huntsville market for 17 years. Recently moved down here to Pensacola in July. So I can't see the list of attendees, but I'm sure I know many of you out there, even though I'm down in Florida now, so I get to wear a golf shirt all the time.
So this is the first part of our guest speaker series. We are very happy to have Rich Raleigh with us today. Rich is with Wilmer & Lee. They've been a great partner and source for our firm when we need legal expertise or legal advice. Never hesitate to reach out to Rich, and him and his group provide great service to our mutual clients and provide advice to our firm as well. Rich, thanks for joining us today.
Happy to be here. Thanks for having me.
So Rich, you want to tell a little bit about yourself and your areas of practice, and of course your legal footnotes that you're required to do as well?
Sure. So like you, I do focus my practice primarily on businesses, and in this area, that's a lot of government contracts businesses. I was in the Army JAG Corps before coming to Huntsville, moved here in 2000, and I speak frequently and practice frequently sort of in the area of government contracts. I handle a number of sort of mergers and acquisitions, including the novations and other things that go along with that, Brandon, as you well know, because you and I represent a lot of mutual clients going through some of those issues. So that was sort of the reason why I guess we all picked this topic. There's a lot of M&A work going on these days, and in the government contracts area specifically, it can be more complex.
Absolutely. It's very active market for M&A right now. As Rich mentioned, we're working on several together. And so why don't we jump right into our first poll question? And I should introduce the fourth part of our presentation here, Cammie Miner. She's behind the camera, if you will, but she's making a lot of this go for us. And so, Cammie, I can't see if the question's been launched yet. You'll have to let me know when we're safe to go on to the next one, the next slide.
I just launched the poll.
So while everyone's answering that, when we talk about mergers and acquisitions, as I mentioned, we're either our firm is either working with several right now or have clients positioning themselves, thinking long-term towards some type of M&A transaction, either as a seller or a buyer in the transaction. And we typically see, we have at least one of each of these going on right now, but these are the type that we would typically see of transactions. On one end, just a purely investor purchase, someone coming in looking for a return on their investment, much like if you bought some Apple stock, you come in looking for return on investment. We're seeing more and more private equity groups get involved in the government contracting space, which I think is a little departure from prior years. Strategic mergers, to where maybe you have two companies that each do something really well that maybe complements the other company. And so together they can feel they can form a better force, and as one company they feel like they have a strategic advantage over operating things individually. Also, sales to related party. So maybe we've got some owners, some company executives that are starting to think about retirement, and maybe they are very happy with the company they built, and they want to either pass it on to a key management team. Maybe they have some key employees that have helped them get there, and while they're ready to step aside, maybe they want to continue the company as it is with a different management team in place or a different ownership team in place. And then also ESOPs, or employee stock options, stock ownership plans, excuse me, to where the company would essentially sell to the employees. Now, Ryan, you're a CVA with a firm, lead our valuation practice. When a company gets valued, can the type of transaction have an effect on what that value ends up being?
Absolutely, it does. Yeah, and I would almost say it from the perspective of not necessarily the type of transaction there, but definitely the synergistic nature to it. Really is what kind of changes that value. Most investors are expecting, kind of a 4 to 5 year kind of payback. Is what most investors are thinking of, and so in order to pay something more than that on an EBITDA multiple or some kind of multiples, then they're looking at how can they, increase efficiency, grow the business, change it. And that's where that kind of synergistic relationship comes in if they think they can come in and do it. So, anytime that there's a situation like that going on, it's going to really increase the value for the seller.
Absolutely. And of course, Ryan, when you say EBITDA, we're referring to the acronym for earnings before interest, taxes, depreciation, and amortization, which is really a measure to get the earnings of a company back to more of a cash basis. And so an investor can measure their payback period, as Ryan mentioned. Rich, right. What are you seeing any more of these than others? What are you guys seeing in your firm?
Well, before we started here, I was mentioning to you one that I'm working on now that's a strategic merger that involves kind of cyber security stuff. I gave you those that general pattern. I think strategic mergers you're seeing quite a bit. Last year, we heard of a number of kind of large government contractors here selling, and they were kind of outside the area. Private equity purchases, out of DC and some other kind of private equity venture capital firms that have bought in. And some of these things also relate to the type of transaction and the structure side. So, investor purchase, as we'll go through these slides today, we'll talk about liabilities and risk and so forth. If you're private equity and you're looking for just some investment return, you're less likely to become personally invested, your own sweat equity sort of thing, and you're going to be more concerned about liabilities and risks than if you are part of the present management team, and maybe the older people are selling out and the younger leadership group is buying in, sort of thing.
Rich, that's a great segue to our next. Sorry, Ryan, did you?
I was just going to say, to kind of close the loop on that too. It's always been you're in a better situation if you don't have to sell, if it's something that you kind of are happy with, and then you're not quite as concerned about the price, and that always increases that negotiating power a little bit.
Absolutely. And as we talk through this, we're going to cover some things high level. There's a lot of intricacies to these transactions. A lot of different ways to structure the cash up front versus owner finance versus potentially shares in a new company. And so we're going to hit on some high levels of things, so please don't hesitate to ask questions if you do have something more specific. So, when we kind of start thinking about how a deal could be structured, there's really kind of three ways to look at this. A stock sale, in which case the shareholders would take their stock in the company and sell all of the stock to the potential buyer. Now, when that happens, there's a few different things. Generally from your customers, there is no required approval because the company is still intact. We've just sold the shares of it. There are some exceptions with SBA programs, which we'll cover a little bit of that later, to where they do get involved if there's ownership changes. Rich, one of the big things on that though is if I buy the stock of a company, I kind of get the good and the bad with it, right?
Sure. Yeah. I mean, stock purchase, the pro of it is, generally speaking, no government approval, and the seller, has no guarantee in the future. The cons is you retain all the liabilities, including penalties, because the corporation continues to exist. It just has new people owning the stock. It makes the due diligence portion in identifying potentially hidden liabilities and risks, and then the purchase agreement and how you're going to allocate those risks more highly important.
So, Rich, just to clarify for everyone, if I buy a company through a stock sale and they have an issue from 2 or 3 years ago that hasn't been brought to light yet, am I ultimately responsible for that, even though I had nothing to do with the company at the time?
Well, let's hope it never comes to light, and then we won't have to do that. But yeah, generally speaking, yes. So a corporation is its own entity. It's like its own person out there. So it continues to exist. And when you buy the stock, but you buy all the stock of it, you buy the intellectual property, the buildings it's owning, everything it's got. But you also bring on, the liability for not paying at the right wage determination for a service contract act. And DOL comes in and says you got to pay these employees back pay, or you got to pay them benefits because the corporation didn't do it previously. You got that liability as well.
Absolutely. And Ryan, we mentioned the way these deals are structured. They can go a lot of different ways, but generally speaking, this is more favorable from a taxation standpoint. A stock sale, is that
absolutely, yes. Stock sale, I mean, think of it like you're selling your public stock, your Apples, your Disneys, your Coca-Cola, all that is going to be a capital gain transaction for the seller, which is always well, actually, at least right now, preferential at the tax rate. There is some give and take on that, though. As we talk about the asset sale, a buyer is always going to want to do an asset sale because they're buying assets, which means now they get to put them on their books as assets and depreciate those. And as most of us will know, a lot of times we get to accelerate depreciation from a tax standpoint, and so they'll get to take a lot of that deduction in year one, as opposed to a stock sale where they're just essentially investing in it and it's not a deduction. So kind of a give and take there. Seller's always going to want to go a stock, buyer's always going to want to go an asset.
I'm going to do the course. Hold on a minute. Hold on a minute. It may not be better for the buyer because novation, you know, one of the assets of the business is the contracts that it's got. So Ryan's exactly right on sort of the tax treatment of the asset purchase. But one of the things you hope you're getting when you buy a government contracts business is all of these contracts that it has. And in a stock purchase, generally you don't have to go through the novation process and get the government to approve the move of everything over because the same corporation's doing the same work. But on an asset purchase, you got to do a novation, and it can be complicated.
Absolutely. So we've got some pros and cons on each, and so each buyer and seller in each company may be different in their circumstances on what they're trying to accomplish. And then of course we have the merger, which is taking two companies to form one new company, right? And so it's a little bit of each, you know, some of the pros and cons, and we're going to get into all this innovation and things a little bit more, so we can talk about how each of these affect that. Now, Rich, we've already thrown the comment of the term due diligence around a little bit. You've hinted on it, but you know, if a client comes to you and engages you and Wilmer and Lee to perform due diligence, what does that mean for them? What are they really getting?
Sure, due diligence is really trying to find those landmines. So if you think about an M&A process as a timeline, and we've got this later in the slides, but you know, your initial preparations, you're identifying, if you're the buyer, you're identifying a possible target. And then you have your sort of initial discussions. And I'm hopeful at that point, even you have a non-disclosure confidentiality agreement where you can start talking just in general terms. You know, me and Brandon are talking about, I'm going to buy his business. So we want an NDA in place. But the next thing you're going to do is get more serious about it and do some due diligence. You're going to dive in on things like what the corporate records look like. Are the people paying the correct wage determinations? What tax issues exist out there? What legal issues exist out there? And it's important for both the buyer and seller to identify these things. And if you start to look at a due diligence list, really, you ought to get your hands on one of those early if you are someone who's thinking of selling your business, because those are the things that a buyer is going to look at. And if you can take care of some of those things, pull things together now, identify issues and take care of them, it might increase the value, right, Ryan?
Yeah, we'll get into that slide a little bit later on as kind of the very high level of how to value, but risk is one of those. And so as much of these risks as we can check off on the front end, liability being that risk we're talking, the better.
So Rich, is it possible, and do you guys ever see if someone maybe starts out thinking they're going to do a stock purchase, and then as they go through the due diligence process, maybe some red flags pop up or some things are identified and they switch to an asset mindset so that they can maybe avoid some of those issues?
Yes, and occasionally it goes the other way. The person that makes a decision on a novation is generally the contracting officer that's kind of got the lead agency. And you don't get a kind of a pre-approval of a novation, but you can run the thing by them. If it looks like they're unwilling to do a novation, then maybe the stock purchase is your best way to do it, just so you don't have to go through that. So it can work both ways.
So let's talk about this with the GovCon slant then. So we've talked about novations a lot, and while you know a lot of different or a lot of different entities have contracts. It's a special thing having a contract with the federal government. Rich, doesn't that add a new level of issues to think about?
Sure. Yeah. I mean, they're almost all acronyms, but think about ITAR and the international trade rules, but you also have cybersecurity, ethics, wage hour laws, and FCA, OCIs. I mean, the FAR is so involved in so many different things, on your accounting side, but also on our side of the thing. So, TINA and the Truth in Negotiations Act on pricing and cost, all of those things are things you have to figure out and resolve in the due diligence phase.
So when we've got
Brandon, quickly. Yep. Sorry, we got one shout out here, and before we get too far removed from some of that due diligence and pricing stuff, I'll read it. It's from John Miner, and he asks, can you realize the value of an NOL in an asset sale? So he's obviously talking about net operating losses, tax losses in there. John, that really depends on the transaction type. Yeah, as we talked about, if it's a stock sale, then the company is going to continue in existence and operate, and then typically, yes, that would be an asset that the company can value and put somehow in the negotiation. If we're talking about an asset sale, well, you're buying the assets. The NOL belongs to the company, and so the NOL would essentially die with the company in an asset sale. So hope that answers that yes and no. Is that for a perfect answer, Rich? Is that a good legal answer?
I really think that one's more yours, but yeah, I think you got it.
Yes and no.
So, Rich, generally speaking, it seems like the novation is a big deal on this. Is the federal government, when they've entered a contract with someone, obviously we've all been through the procurement process. We know how involved it is. And so when the government's evaluating these things, what's going into that process with them? If I'm a service disabled veteran-owned small business, and my contract is a set aside for that designation, what do I need to think about as I'm thinking through these transactions?
Sure. If most of the contracts in the target business are set aside for a particular disadvantaged business, then the buyer may need to have that same disadvantaged business qualification for those contracts to move over. And that's just really the short answer. The Anti-Assignment Act prevents one company from just buying a government contract from another. But through the novation process, the government can permit the transfer of contracts from one to another. The selling company still remains liable ultimately for the contract performance, but the new company, with the government's permission, takes over, does the performance, and gets paid. There's a standard form for a novation agreement that's in the FAR. Those things take time and money to push through, but it happens with some large frequency. But the issue you've identified here on the slide, can it still qualify post-transaction? Not always. So if I have a contract that's a set aside for service disabled veteran-owned small business, and I'm selling it to your business, Brandon, and you don't have that qualification, then the government probably won't permit the transfer. And contracts that are transferred, could always be terminated for convenience, because the government wants to get the credit for those set aside things.
So let's say I do everything right, and maybe this contract isn't under a set aside, but I go through an asset sale and I, fill out the request. Can the government at the end of the day just say, no, we're not going to novate this contract?
Yes. There is no requirement that the government permit it. But the government, what they are looking for is someone that has the responsibility to provide the services. And they don't deny them just because they want to. I mean, they happen with some frequency. And if you go through the steps and give them the information that's set out in the FAR, then usually they'll approve them.
All right. We're going to talk about some cost allowability issues, which is always a big topic with our clients when they are, in government contracting world, it's pretty much every transaction we evaluate it for cost allowability. We want to include those in the rates. And so we're going to talk about a few things that come to light with cost allowability. Before that, I think Cammie was going to launch a poll question, kind of asking if you joined us on this seminar, we're assuming that mergers and acquisition is on your mind, and just kind of wondering, do you have a company that you either work with or against? We call them frenemies sometimes. Do you have any company like that you think could be potential acquisition, merger candidate, someone to sell to? So we'll get the results in on that. And while everybody's
a couple moments to actually take it, and then I can post the results so you guys can see if you would like.
Yes, please do that. Please do that.
Okay, we'll give it another 5 seconds. 5, 4, 3, 2, 1. Closing the poll. And there's the result.
Oh,
There you go.
yeah.
All right. So, Ryan, we've talked about a few different things from the accounting structure here, and you and Rich have both hit on, there's an intangible asset when you're buying a company. When I look at a purchase price of a company, I can certainly identify multiple assets, be it fixed depreciable assets they have, contract, but usually there's also some type of intangible in there that bridges us to the purchase price, be it company reputation, past performance, those kind of things. That's typically a part of goodwill. But when we're thinking about the government contracting world, and when we're thinking about this transaction, as a acquisition gets recorded, when we purchase a company in non-GovCon world, we record those at fair market value, the assets and liabilities, whatever they may be, and the difference goes to goodwill. So a couple of FAR clauses address this. In non-GovCon, when I mark these assets to fair market value, I'm able to depreciate these assets at the new value as they've been recorded at the transaction, take depreciation on them for tax purpose and those kind of things. FAR 31-205-52A tells us that we cannot write these assets up or down in GovCon world. And so basically the assets just have to come over at whatever the existing value is. The other piece of that, the goodwill that we sort of have alluded to a couple of different times, the difference in sales price and identifiable assets, again, for tax purposes, we're able to amortize goodwill, and it can be very favorable for a buyer to have this goodwill on the books and amortize it. However, in the GovCon world, FAR 31-205-49 tells us we cannot amortize the goodwill. So we are not able to write it off and take that expense in that case. So these are some of the unique rules Rich was alluding to when we look at transactions in government contracting that make it different from the rest of the transactions in non-GovCon world. So another kind of
Sorry to jump in there and to change the slide,
Yep.
Brandon. I'm just doing a sound check. The one technical issue I didn't check was that my headphones were fully charged, so I had to do it. Do a change.
You're good to go. So, these next two slides are, the FAR can be very gray. It can be very black and white in some cases. It can be very gray in others. And so FAR 31-205-27 tells us that any cost associated with planning or executing the organization or reorganization, and specifically names mergers and acquisitions, are expressly unallowable. So that's telling me any cost I have for, there's some of them are listed out in there: attorneys, accountants, brokers, all these are unallowable costs. But if I dive a little bit deeper into a different FAR clause, FAR 31-205-12, it tells me that economic planning costs are allowable. So if I want to think about long-range planning and maybe the need for M&A or other strategic initiatives, when I'm in those planning meetings and when I'm dealing with that, those are allowable costs as I'm thinking of the need to do that. So what we'll see clients do is they're evaluating their business, and they say, hey, we do need to do some M&A, we need to grow, or we need some synergies to be more profitable. We're evaluating multiple companies, so multiple targets. They'll keep that allowable under FAR 31-205-12 as here. But once they identify a specific target and the due diligence piece starts, the pro forma financial statements start, at that point, we'll switch over to unallowable. So it's a pretty gray area there, but part of that's knowing the rules and understanding, at what time do you do different things. A couple other FAR clauses that can come up through M&A transactions. FAR 31-205-6 compensation, particularly as it relates to golden parachutes and stock transactions for key ownership. FAR 31-205-20 tells us interest is unallowable. Most deals that we see, at least some aspect of it is financed. Some of it may be cash on hand that the company has, but generally at least a part of it is financed, and so any costs associated with that would be unallowable. And then for any of our attendees that specifically deal with DoD, DFARS has an extra kind of clause about external restructuring costs, and they are generally unallowable unless you're cognizant DoD official, unless you can prove to them that there are savings through the restructuring, at which case they may allow some of the restructuring costs to be allowable. So, beyond just some FAR clause and keeping things allowable, or understanding the rules so we don't get in trouble for what is unallowable, there are some other considerations as we go through this. For example, if I have customers I'm working with, obviously if I'm planning to do innovation, I need to make them aware of that. Rich, is there any other times I need to make people aware of any advanced notification or changes, or is there anything I need to watch out for on that?
Well, sure. We talked about in preparing for this, advance notice of a possible purchase or announcing to the public that it's going to happen, a proposed transaction. Those things can affect a number of things, including potential impending or pending bids. The SBA affiliation rules kind of touch on this area. Your plans and a letter of intent to purchase, that could affect the SBA's present effect rule, which basically says, if we have a letter of intent that I'm going to buy your business and you're going to sell it to me, if it is specific enough, definitive enough, then the SBA is going to consider that that's something that's already going on, give it present effect, and therefore we could be affiliated entities. And most of the people listening in here, if not everybody, understands the affiliation rule. Now your receipts and your employee account and mine are added together, and so that can affect things a great deal. Two sort of size protest cases give us some information about that, and essentially the letters of intent don't need to be completely definitive. Although there's a lot of factors, if the letter of intent talks about a price but stipulates the price is conditional, on meeting certain financial targets, for example, that could protect you. Announcement of a proposed transaction can impede pending bills. I mentioned to you the Lockheed Martin case, GAO case in 2016, where, you know, after submitting a proposal, Lockheed announced in a press release that it entered into an agreement on something, and the Corps of Engineers said, well, that could create risk and cost uncertainties, and kicked them out. And essentially, GAO denied the protest, saying the agency can analyze and should analyze stuff related to corporate restructuring, and so there's problems there. You've also mentioned on this slide defective pricing, False Claims Act issues. You know, the Truth in Negotiations Act requires contractors to disclose to the government all of its cost and pricing data and certify it's true, current, accurate, complete. A potential sale or a sale could affect the cost and price. And if the government decides that your costs and pricing is not current, accurate, and complete, that could lead to bad things. False Claims Act has both civil and criminal penalties.
So, Rich, to make sure everyone attending is clear on this, if I'm entering into a potential transaction and let's just say we're fairly certain the transaction is going to go through, and I know potentially, let's say there's cost savings to me because I'm combining two entities, and so, you know, I've done my forecast and I know my G&A rate's going to go down, but I bid my G&A as it is pre-transaction. I've defectively priced this bid, correct?
That could be true. So, you know, back to sort of our timeline, you know, you start with identifying a target, then you start having some discussions under an NDA, you know, then typically after sharing some initial information, you would enter into something like a letter of intent and then do, you know, more due diligence. What I'm saying is be careful with announcements and be careful with signing something that is sufficiently definitive that it really binds you to buy or sell. If you enter into a letter of intent, you need to have some squishy language in there. You know, the parties at the present moment intend X, Y, and Z. You know, the price they anticipate could be this, but things could change. You don't want it to be a complete commitment. Otherwise, you run into problems where this could be present effect. This could affect these things. And when you do get down to the moment of, yes, we are going to buy and sell, then one of the things in due diligence you're looking at is all those pricing things, all that cost pricing information, and you may have a duty to update it under the Truth in Negotiations Act. So whether you're in contract performance or otherwise, you may need to inform the government, hey, something's about to affect our cost. The problem with the Lockheed Martin case at GAO was they didn't tell anybody. They just announced that they were going to go through with this deal.
So if what I'm hearing, it sounds like the best course of action, if possible, is to remain somewhat ambiguous, not committal until you get to the final steps of potentially a purchase agreement, as long as we can have some outs in case the deal falls through, and, you know, and not paint ourselves into a corner. Is that what you typically advise clients in most cases?
That's right. One of the things the letter of intent usually does and should do is creates this period of exclusivity with regard to the discussions. You know, Brandon's talking to me about selling his business to me. He's not going to talk to Ryan or anyone else about it during this period of time, but not so sufficient that, you know, it's essentially the contract sale document itself.
Okay. So, you know, we have on here protecting technology, but there's actually a lot of things that should be protected, because when you go through the due diligence process, you're kind of opening up everything for people to see. And so they may get insight to key employees, intellectual property. At what phase of our timeline do you know, potential M&A participants need to be thinking about those, Rich?
So during the due diligence, you're going to identify, you know, is the seller performing government research and development prime contracts, subcontracts? has the government or has the contractor gained substantial IP rights and so forth? It's gonna go one way or the other. You just need to find out during due diligence what exists out there. Are there? I think you mentioned this, the key personnel that we need to keep on, and perhaps there's a non-compete or some sort of employment agreement that needs to be signed as part of this. All these things can affect values, can affect risks that need to be dealt with. So during the due diligence phase is when you kind of figure all these things out. And I think your next slide deals with kind of the financial due diligence aspect.
Absolutely. And so before we get into this, I did want to mention Rich and his firm have spent time developing some checklists and some documents to assist either if you're starting the due diligence process or just thinking about what it may look like. They've graciously offered to share those with anyone. So if you want to mention in the chat, if that was something you'd like to have, we'll make sure and get you a copy of those from Rich and from Wilmer and Lee.
Yeah, so caveat, no form is perfect, but I shared with y'all, and either you can send it out or we can send it out, kind of the initial non-disclosure confidentiality agreement, sort of a form letter of intent that we work from, and then sort of a due diligence checklist. They're good starting points for all those things.
Absolutely. Now, Ryan, you and I both have been auditors at some point in our career. So financial statements and assets and liabilities, how these things work, we're familiar with them, but how do they kind of go into the valuation process? What are you looking at on these financial statements? And I guess at what point, would we start putting more and more reliance on them throughout the due diligence process and when we're evaluating M&A transactions?
Sure. In the valuation process, obviously and we'll get in, we've got a slide here kind of about at a high level about how that process works. But obviously the financial statements are a big part of that. We're trying to figure out what is the benefit stream, what's the company generating from a cash flow standpoint in order to be able to value it. And so, in any part of due diligence process, you're going to be requesting that information to try and perform those calculations. And as we got there, you're kind of looking at the underlying assets and liabilities within that. We talk about the levels of financial statements there. Obviously, if it's an audited financials, you're going to have all the footnotes, which is going to explain a lot of that stuff. It's probably going to bring to light some of the liabilities and those risks that we talked about as well, as you're talking about potential liabilities out there, things like that. But yeah, the financial statements obviously is the main driver in trying to figure out the cash flow that the company's generating.
Brian, when we're working with valuations with our clients, it seems like we look at the balance sheet and income statement, these financial statements, and we're trying to get a good picture of their financial health. But the majority of the clients we deal with in the government contracting space, their balance sheet doesn't have a ton of assets on it, and really that bullet point a few slides down, the backlog, you've talked about this before, that the cash stream of these contracts, is that really kind of one of the biggest drivers on the valuation?
It's definitely looked at, and obviously the backlog that the company's got is a good indication of what they're currently working on, what their capacity to perform is. But a lot of the downfall we hear there from clients or from companies is that they think that backlog is the value. In the valuation world, we have to assume that this company is a perpetual company. And what that means is after these current backlog of jobs end, there's going to be the next contract that comes up and replaces it. It's not as if the company's going to work out the current backlog and then it's going to shut the doors and that's going to be it. So that's the value. So yes, we'll definitely look at the backlog. That'll kind of give us a gauge of what the company's capacity is, how much revenue they're able to generate, and then make some assumptions as to what we think they can do in the future, and whether that's to increase the backlog, increase the potential workflow, or kind of work at that same level. But it's definitely obviously a big indicator in the government contracting space, because that's basically 100% of the revenue.
So Ryan, make sure everyone's kind of clear on this. You know, everyone on this call is in the government contracting space at some point. And so everyone's familiar with incremental funding and one-year contracts with option years. And so as we're looking at the backlog, we have an understanding that these contractors have proven that they have the ability to go win new contracts and new awards. So as these start dropping off, at some point we say, even though they dropped off, based on historical performance and what we know from the company, perpetually we believe they will keep winning, they will keep getting awards. Is that correct?
Correct.
All right, good. And, you know, just a couple other things, cost, you know, when you're looking at the financial checklist, you know, if you've got, as Ryan mentioned, audited financial statements or some type of statements from a independent CPA firm, you can put a lot of value in those. Should you not, you want to really look at labor and other costs and really think about, is everything captured in there? Am I looking at the right picture? And at times there may be costs that you would potentially add back when you're looking at a company from a financial perspective. Indirect expenses, maybe you've got a company and after the sale, one of the key members of management is going to retire and go to the house, and so maybe I would add their salary back. Or maybe the acquiring company has a larger office and they're going to move the smaller company in with them once the merger takes place, and so now I have less facility expenses. So there's different things like that that can be looked at and need to be analyzed as you start thinking about, one, what's the company I'm buying look like? And then two, what does it look like the day after the transaction? Now,
that's exactly right. I was going to just add to that real quickly. You know, when we always, it's kind of always thrown out there that the multiples, that's kind of the easiest way to do it, right? You take your EBITDA, you figure out your multiple, and that's your value. The one thing that we really have to do is exactly what Brandon mentioned. We need to really dig into that EBITDA number and find out if there's any adjustments. I'm sure most everybody on this call is in the small business world. And we know in that small business world, not everything that runs through that company is legitimate necessarily. Not all the wages that we're paying the owners are legitimate. And sometimes that's high, sometimes that's low. You know, if cash flow's in a pinch, the owners may cut back on their salaries. So I'm not to say that that's necessarily going either way, but there's a lot of adjustments that we'll go through and kind of scrub that EBITDA a little bit before we just simply come up to a multiple to figure out the value.
You know, these are a few highlights from the checklist we referred to that we're happy to share if anyone requested. Not meant to be all inclusive, but you know, that was from the accounting side. Rich, some of the legal things, what are some of these that pop out to you that you're, you know, during the due diligence process are consistently having to advise your clients on, make sure they're aware of? Are there any of these you're digging into more than others?
Yeah, so I mean, this is a good list. We've talked about some other things. You know, some of these are the things that you can work on cleaning up before you really go to sort of put your company on the market if you're the seller. There are definitely stuff you want to look at if you're the buyer. You know, articles, incorporation, bylaws, meeting minutes. You know, what exists out there, what leases exist, all those. You know, there's other things to think about, and that is sort of like organizational conflicts of interest. You know, if the buyer and seller are involved in a similar area of work in government contracting, it can create OCI issues. What bid protests or lawsuits exist out there? Status of legal proceedings is mentioned on that list. But, you know, things can differ, and non-U.S. buyers could have additional requirements. There could be export control requirements, ethics and compliance. You know, one thing that we sort of see frequently is, you know, small business grows and gets bigger and bigger, but they don't go through the process of having a code of conduct, ethics policy, mandatory disclosure stuff. You know, is there someone at the target business who's responsible for receiving whistleblower complaints and compliance issues? You know, what cybersecurity issues exist out there? taking stock of teaming agreements and joint venture agreements and subcontracts that exist. All of that is sort of part of the checklist of stuff. And OCI and potential protests are some. One of the things you want to look at, it mentions ERISA here, so that's sort of the benefits. I think when we were doing our preparation for this, I talked to you about SCA issues. A common area is this, SCA being Service Contract Act. So the target company has, or potential seller has been paying at a particular wage determination, or has decided that certain employees are exempt from overtime when the DOL later decides they should have been non-exempt and paid overtime. Well, that creates an issue, and there's trailing liability. There's statute of limitations for a period of time, but there's sort of trailing liabilities on that. That happens over and over again. You buy the company, and then a year down the road, Brandon, who's been paid as a exempt employee the whole time, turns around and says, I should have been non-exempt. I should have been paid overtime, and I was here from 7 o'clock in the morning until 7 o'clock at night every day. And you got to go back and calculate overtime. If you've done a stock purchase, you're on the hook for, paying those wages.
We have capital stock registered in a lot of organizational documents on here. Do you ever see cases where, a company's starting up and we decide to give Ryan, 5% of the company while we're getting going, and then he's been long gone and we kind of forgot we gave him shares? I mean, that doesn't happen, does it?
That doesn't happen quite as frequently as just not having all the documents. Here's what happens. I mean, small business starts, everything's great. You've got a couple of founding people. You go to your lawyer and get the thing set up as an incorporated entity, and you get your book. They hand you your 3-ring binder of your corporate documents, and you're supposed to have meetings every year and keep, put the meeting minutes in there and so on and so forth. What happens is people just don't do that. I mean, and I'm not saying that they're terrible people. This is what always happens, just about, with small businesses. But when you get ready to sell, you pull out this corporate book, and it's still got the 2 certificates to Brandon and Ryan, even though we promised everybody else, some interest or share, and there's no meeting minutes. And that's why I'm saying, it's good to get a copy of the due diligence checklist and start fixing some of these things before you go into this. That all of that happens frequently, and typically you can get it all worked out and get everything in order. It just takes some doing.
That's one thing I think Ryan would agree we find in our world, is that we can generally fix the things if we have enough time and notice to do it. It sounds like it's the same from a legal standpoint. Cammie, how about we launch question number 3? Have you ever had a valuation? And really, maybe you haven't had a formal, but do you feel like you know what your company's worth? So we'll maybe give that a few minutes, and then Cammie can share the poll results. We'll let us know when we're ready to move on from that.
Okay, I'll give it just a few seconds if you guys will take some time to answer the poll question. All right, and I'm closing the poll now. And there are the results.
Okay.
Well, as we start looking at valuations and talking about that, Ryan, when somebody says valuation, is that always the same thing? I mean, what does a valuation mean?
No, similar to the financial statement world, there's multiple different levels of assurance or of levels of service that we can provide, just like the audit, the review, and the compiled that I'm sure everybody's kind of heard of or at least familiar with a little bit. In the valuation world, we have a full valuation and we have a calculated value. And again, similar to the audit and the review and the compiled, that just changes a little bit of our requirements and our level of digging as to what we're getting into. The highest level is a full valuation. That's where the valuer is giving you their opinion of value to that company. A calculated value is more of a little bit more back and forth between management and the valuer to kind of come up with a reasonable formula, a reasonable methodology that everybody's comfortable with, and essentially running that calculation based on management's assumptions. So usually a little quicker turnaround, a little cheaper, but they really have their own place. A full valuation in the real world is primarily used for a tax transaction, estates and trusts, or legal proceedings, whether a divorce case or something like that. That's typically where you're going to see a full valuation. A calculated value is typically more appropriate in most of the situations we see, which is the company owner is looking to exit, to sell, and they're just kind of get an idea of what the value of their company is. We'll do many of the similar procedures. We just won't be, like I say, won't be digging as deep in a calculated value. So it's a good way to get an idea of what the value of the company would be without spending a tremendous amount of time and money.
So Ryan, you mentioned the process is similar for both. What does that process look like to determine the valuation, whether they do a full valuation or elect to have a calculated value?
Yeah, so basically we're going to come and you see the first bullet point there is kind of the formula. Essentially is what we're doing is we're trying to figure out what is the benefit stream and what is the risk. We've mentioned that many times throughout this slide, but benefit stream times the risk is the value of the company. And so example I'll use is, Rich has promised to pay me $100 1 year from now. Okay. We know the benefit stream. The benefit stream is $100. The risk, it's a year from now. We don't know if Rich will still be alive. We don't know if Rich will have $100 a year from now. And so we gotta kind of weigh those two up. And obviously, when you take that to a business setting, the benefit stream, typically we're going to look at a revenue, we're going to look at EBITDA, we're going to look at seller's discretionary expense, discretionary earnings, which essentially is kind of a hybrid of what the company's made plus what the owners can take out in the small business world. And as we mentioned earlier, we're going to do some adjustments to usually those EBITDA numbers or those benefit streams to normalize them a little bit more, to know that a third party buying it is probably not going to make some of the same decisions that a small business owner would make in the day-to-day operations. And then we're going to weigh the risks, just like we've talked about there in many of these slides before. Look at some of the uncertainties out there, the liabilities that may be in existence. We typically will look at a build-up method is what we typically use, and what that means is we're going to look and see, okay, an investor's always got the option to go out and invest in the market. That's pretty easy investment to make. So that's kind of our starting point, and typically the returns in the market 6 to 7% historically, and so we're going to start building it up from there and add some company-specific risk. Look at the management team, look at these liabilities out there that we talked about. Look at the overall operations. How efficient are they running operations? The ownership and management team. If the company sells and the owner is the only one that really has any insight knowledge, company sells, the owner steps away, can the company continue? So that's the risks we're looking at as we're trying to determine that risk side. So, you can really have two ways of increasing that value: is increase the benefit stream or decrease the risk.
And can I add one thing here? We're getting to the top of the hour, but we're also getting to the end of the slides, I noticed. In terms of value and risk, the due diligence is to discover and uncover risks, and then the purchase agreement can allocate them. So you use things like reps and warranties, indemnification, and earnouts to allocate risk that you identify, and representations. That is what you're saying is the truth. What are our monies? What are the liabilities that are disclosed? your warranties are, if it isn't right, what happens. Indemnification is, you step in and defend against that SCA, undisclosed liability type thing. But using these tools in the purchase agreement itself that would be drafted sort of, back to the timeline, after you do the due diligence, determine a value, using people like Ron and yourself, Brandon, to help you figure that out, looking at the risks and trying to put those into some sort of monetary amount. Then you plug all that into an agreement that hopefully you'll come, ultimately sit down and sign. And that agreement can help allocate some of that risk.
All right. Ryan, we've talked a few times about EBITDA, earnings before interest, taxes, depreciation, and amortization. A lot of times that's factored as a multiple, which would bring us to our fourth poll question. A lot of times those multiples are floated around about what should I expect as an EBITDA multiple for my company. Ryan, a lot of times it depends on the transaction type though, correct?
Yeah. As we talked about earlier, is there any kind of strategic value to this, any synergistic values to this company? As the multiple goes up, well, then the return to the purchaser is the return on their investment is lengthened, right? And so the only reason somebody's going to wait longer to get the return on their investment is if they think there's a way they can increase that EBITDA number, greater than expected. And so you're obviously looking at some kind of strategic strike or synergistic marriage there that kind of brings that together.
All right, Cammie, are we at a point where we can share the poll result? And I can't see them, unfortunately, because I'm presenting. So you guys will have to tell me if there's anything earth-shattering in there.
Yeah, 2 to 4 is 56%, 5 to 7 is 44%, and greater than 7 is 0.
That's exactly what we talked about right before we got on here live. Was we're kind of seeing that out there is kind of that 5 to 6, 7-ish range, and so that's, I think everybody's spot on with those answers.
All right, we are running short on time, so I'm not going to spend too much time on this other than to bring up the point for everyone to think about. The Payroll Protection Program, the PPP, was a part of the CARES Act, which was enacted in March as part of the COVID-19 economic stimulus. The PPP loans were administered through the SBA 7A loan program. Historically, when the SBA is involved, they have to approve ownership changes, which would include M&A transactions. This is no exception, although they did clarify some thresholds of when approval will be required. And so the long story, or the short story is that if you are thinking about an M&A transaction, it may be better to go ahead and get your PPP loan satisfied and closed out if you're going through the forgiveness process before getting too far into it, as it could cause some slip-ups there. But we'd be happy to provide any more detail about that going forward. Rich, as we kind of put a bow on this and wrap it up, we've got a timeline here. If somebody is thinking about an M&A transaction, at what point should they pick up the phone and call you to start getting Wilmer and Lee or yourself involved?
Well, initial assessment sort of is that period where if you're the seller, you're kind of trying to clean up the document stage. And if you're the buyer, you're out there looking for targets. Preliminary discussions is sort of where you need to have the non-disclosure confidentiality agreement. So, at least somebody needs to do that. And an attorney can help with that, certainly. A lot of companies sort of talk about teaming opportunities all the time and may already have their non-disclosure agreements. Step 3 is really sort of important for them to contact someone that can help them with value and liability issues like y'all, and also attorneys, because at some point you got to start working on letter of intent and purchase agreement. You know, and hopefully you get to this step 5, signing to closing, and the seller, you know, gets a bundle of money and retires to some island, or they stay back and work it for their earnout, or, you know, have stock as part of the deal. The buyer at that point still may have some notification stuff, you know, updating SAM and website and so database and so forth, updating names on licenses with export controls. There's still some work to do, even in step 5, but hopefully that is the you know, the end of the race where everyone's happy and everything goes great.
So, you know, looking at the months there, the timeline is somewhere between 3 and 7 or 8 months. Does that feel about right for a transaction from start to finish for you?
Some can be more complex and you know, but yes, that I think that's about right. And you know, the thing can either move more quickly depending on, you know, how it goes. You know, if it's the management team buying the stock or something, things could be more quickly. It could get, I mean, everyone who's ever been involved in these know that it can get derailed at any time as well.
Absolutely.
Yeah, the math part and the legal part is kind of the easy parts. It's the human emotion part that usually slows them down. So just quickly, we got one question out there that John Miner again had posted out. I guess he is the only one out there in the crowd because he's the only one asking questions. But John has asked the question, what is a 409A valuation, and does that differ from a calculation of value? So John, a 409 valuation is not really a thing. 409 is a deferred tax or deferred compensation issue of the IRS. And so typically what the IRS says is if you're given an employee deferred compensation, then you have to value it and calculate it. And so we will do a calculation of value typically to come up with a value of stock, a value of options, and use that for the 409A issue. So a calculation of value would be appropriate in that setting typically. What the IRS says, without getting into too much detail and the interest of time, is essentially as long as it's consistent and it's reasonable value, they usually don't give, they'll give you some leeway on that. And so that's probably the most common reason, either that or some kind of stock issuance transaction is where we most commonly see the use of the calculated values engagements.
All right, Rich, we certainly appreciate your time, your expertise, and your knowledge, and sharing that with us. We do have some additional upcoming webinars. 2 weeks from today, we're going to talk about going from sub to prime, what you need to know and be aware of on that. 2 weeks following that, we're going to talk about the ins and outs of leases during COVID, and also talk about property ownership as a government contractor and some ways to maximize value there. Rich or Ryan, any parting thoughts before we close it out?
None for me. Thanks for letting me participate.
Absolutely.
Very good.
Thanks to all our participants. Sorry we ran a few minutes over there, but we appreciate everyone's time, and we hope to see you again at our next webinar. Thank you.
Thanks.
Goodbye.